Mike Desepoli here, Heritage Financial Advisory Group. Hope you're all doing well. Happy New Year. Welcome to 2018. You know, it's really hard to believe a new year is upon us, but this gives us a great opportunity to reflect back and take a look at 2017, what went on in the markets, what went on in the economy, you know, what was really the catalyst for it all, and how can we move forward into 2018 and take full advantage of the financial opportunities that are in front of us. So that's our goal here today. We want to recap some of the action, some of the highlights for 2017, and let you know where we go from here and how we can make the most of 2018. So looking back in 2017, obviously we had a very strong, robust year in the markets, with the average return for the U.S. stock market indexes running around 19% on the S&P 500. So a great double-digit year. We saw a lot of growth in many different areas of the markets. Many different asset classes performed well in 2017. So what was really driving the growth? Well, we have a couple items on our agenda here today. Number one was the speculation of cutting taxes, both business and individual taxes. Obviously, that creates a lot of euphoria in the economy. People anticipate having more money in their pocket when they get their check each and every month, and businesses anticipating having more money in their operating account, which will lead to spending and push the economy forward. So obviously the tax bill was not finalized until late 2017, but just the sheer anticipation of tax cuts gave the markets good feelings that they were able to carry throughout the year. Another benefit to the markets in 2017 was the beginning of the deregulation process, trimming back a lot of the rules and regulations that surround small business and make it very restrictive for people to start businesses and obviously grow their companies. So we've seen a lot of deregulation take place. There's much more planned for 2018 and beyond. And as businesses start to become unchained and they're able to operate more freely, we think this will turn into increased profits and obviously will charge the economy up, because with more profits comes more spending, and it's a big cycle that we think will be beneficial for us for some time. We're also looking at renegotiated trade deals as one of the things that was a positive that came out of 2017. Trying to balance some of the trade deficits that we have with countries across the world, which in turn will be beneficial for U.S. products and U.S. manufacturers. And a lot of these good feels are what contributed to the market gains. Now remember, if we know one thing, the stock market is a forward-looking indicator, usually 6 to 9 months into the future. So a lot of people have asked, well, how could all of these policies have had such great effects in the first year when many of them don't even take effect until 2018? And that's a great question. And the answer is, it's the anticipation of what these policies will do that got the markets moving in 2017. We also saw interest rates continue to rise in 2017, with the Federal Reserve increasing rates on 3 separate occasions, 0.25% each time. We see this as a positive, that our economy is strong and moving along in a way that could sustain interest rate increases. Obviously, this does make mortgages a little bit more expensive, but it also, on the flip side, will allow bank instruments like CDs and other savings instruments to pay higher rates of interest, which is good for savers. So that was a lot of what pushed the markets higher in 2017. There really was not many days or weeks or periods of volatility in the markets, which is characterized by those big swings in the market, both up and down. The market continued to march steadily higher in 2017, which may be a little bit of a depart from the norm, what we see. As we know, markets tend to be a little bit more erratic, but we do think that volatility will pick up in 2018 as markets get a little bit more normalized to the economy and how it operates here today. Moving into 2018, some of the areas that we want to focus on are very similar to that of 2017. In 2017, our big winner of the portfolio, the best performing area of the markets, was technology, outperforming the market handily in 2017, and we think those trends will continue in 2018. There are a couple things that we're focusing on in 2018. Number one, the continuation of the effect of these tax cuts. Now that the bill is in place and it is effective for 2018, we anticipate rising corporate earnings. If you think about owning any stock, for example, let's say we own Apple stock. If Apple stock made the same amount of money in 2017 as they make in 2018, but we lower their taxable burden by 15, 18, or 20%, that company just automatically became more profitable compared to the previous year without making any additional money. And we think that effect, with that one example, will spread far and wide through the markets and cause stock prices to increase. So we will seek to take advantage of that. We will also continue to invest and what we call small cap companies. Small cap companies are companies that are anywhere from 500 million to around $1 billion in size. And we think that because they are 100% focused in the United States, that they will see the greatest impact from these corporate tax cuts. So we will continue to invest in those areas and try to reap the benefits of this new tax bill. We also think that the bill or the proposal for repatriation, which is allowing U.S. companies that have money held overseas in other countries, we're allowing them a one-time opportunity to bring that money home, bring it back to the U.S., and they will pay a reduced tax rate if they do so. That should bring a lot of capital, a lot of money, billions of dollars that are currently held overseas, back into the United States. And obviously these companies are not just going to bring this cash back and pay taxes on it just to let it sit here. So we think they will put it to work, increase dividends for some stockholders, maybe share buybacks, and of course reinvesting in their companies and growing their companies. So that's something that we look forward to, and obviously we continue to see economic expansion, and we want to make sure we can stay on track with that. They'll likely try to tackle infrastructure this year. Maybe we can get an infrastructure package together that will be good for the economy. Generally, Republicans and Democrats usually both agree that infrastructure is a good idea to spend money on. Our roads, our bridges, our tolls, things like that that need updating will be a big job creator, and obviously it'll be just good for America as a whole, as our infrastructure is very low and deteriorating at this time. Consumer sentiment, which is a feeling of the investor has about the economy, about both their personal and global economy. The investor sentiment, consumer sentiment, is at the highest level it's ever been, which means people have never felt this good about the prospects of the economy. So all told, we're still managing the risks of the market. Obviously, things seem good right now, but we're never going to be complacent. We like to be, as we say, cautiously greedy, trying to make the most of what we can without taking too much risk. If you have any questions about some of the items I discussed here today, please, I'd be happy to discuss this with you. Reach out to me, give me a call, send me an email. We'll set up a one-to-one where we can talk about this in more detail. Any business owners out there, if you're not sure what the tax bill means and you haven't had an opportunity to talk with your accountants and CPAs, now's a good time to do that so you can make changes and make the most of 2018. Thank you guys so much for tuning in. We look forward to seeing you in the office soon.